If you have a question, wouldn't you want to go directly to the source? Well, that's what I'm doing today with Tim Anderson, or I like to call him Tim the Source Anderson. Is that cool?
That's cool. It's so good to see you today.
You too. Thanks, Tim. Great to have you here on a Thursday. So let's break down the recent market action. What have you noticed?
Well, we certainly had a very big rally on Tuesday, some follow through yesterday, definitely some follow through again today on the major averages. But there are a couple of warning signs out there that the market doesn't have as much breadth across all sectors as maybe we'd like to see. The transport average is underperforming. The Russell 2000 is underperforming. And yesterday, even though the Dow and the S&P gained 0.75%, NASDAQ was up a little between 0.5 and 0.75%. The advanced decline yesterday was only unchanged, and the financials were a little weak. They gave up big gains that they had on Tuesday, and the oil sector was weak with crude trading down another $1.50 yesterday.
Another market mover, while they might not have a ticker, is the Fed, highly talked about. What are your thoughts on the Beige Book yesterday?
Well, the Beige Book really showed what they called modest economic growth throughout the 12 Fed regions. They said it was a very mild uptick from the prior month. The employment picture is still strong to actually tight in some regions. And also, they see no inflation anywhere, in our universe. So all those items are positive, but clearly still the uncertainty from unresolved trade issues is very much in focus for the market, and we need some type of a resolution, either positive or negative, to clear the uncertainty from there, to help people with their forecasting for the rest of this year and into next year.
So are they supporting the economy or stock market when they make these statements?
Well, really, I think what they did was that the Fed funds futures and the Eurodollar futures for late in the year are pricing out 1.5, maybe even 2 rate cuts. Some people would say maybe even 3 rate cuts, which sounds crazy. But with that much priced in, and with the yield curve being inverted now for maybe a week and a half, the Fed just, I think, felt like the market is seeing things that maybe they're not seeing or most focused on, and they needed to make a couple of statements to say, look, if we really need to, if the economy is starting to slip and sputter because of unresolved trade issues or whatever, we will take action to support the ongoing economic recovery. That was one very critical thing they said. The other very critical statement that Powell made was that the yield on the 10-year at what was 210, 212, being below our lower bound, and the lower bound right now on Fed funds is 2.25 to 2.5. He said that is the monetary policy challenge of our time. In English, that means we cannot accept a negative yield curve.
Yeah, that's definitely a scary statement. It is a challenge. Tim, why did you mention the euro dollar?
Well, people will, and I am not a fixed income guy by background, but people that look at what the futures markets are projecting in terms of the number of rate cuts going out in time, look at either Fed funds futures, or they also look at Eurodollar futures, because even though interest rates are 0 in Europe, once the currency risk gets hedged out, it's very equivalent to about 2.25 to 2.40 for our U.S. Fed funds rate.
Nice. What are your forecasts for the jobs tomorrow?
Well, now, of course, yesterday the ADP number came in with a miss. And one of the biggest red flags of that report was that companies that have less than 50 employees lost 60,000 jobs. Now, I'm also kind of bothered by the fact that the Russell 2000 has been trailing the other averages significantly, and even on a day like today, where the Dow is up close to 100 points, the S&P 500 is pushing at that 2835, 2840 level, which would be the next real resistance level. The Russell is down 3/4 of a point. Those are the smaller stocks that typically aren't even that trade sensitive because they might not be doing a lot of business internationally, but they're also the most subject and the most at risk to an economic downturn.
Wow. So what is your prediction for where stocks are going to go since the Russell isn't leading?
Well, I think that for right now, as long as we can maintain solid corporate earnings, and as long as we can maintain some GDP growth for the economy that is, at least 2%. Of course, we hit 3.1 in the first quarter. If we could hit 2% in the second quarter, 2% in the third quarter, that would still give us maybe 2.25% to 2.5% GDP growth by the end of the year. That would indicate a slightly slower level of economic growth, but it would still be decent growth compared to what we had for 5 or 6 years from coming out of the global financial crisis in following 2010.
Well, Tim, you always give us 100%. Thank you so much for coming on the show today.
You're so welcome. It's so great to talk to you.
Tim, the Source Anderson. Thanks, Tim.